Is the best dividend paying stock for Canadians to buy during a recession actually a US stock? Probably, but mainly because the US is bigger and they have more options to choose from. Today, I'll be breaking down Johnson & Johnson, the American healthcare giant, one of America's oldest companies, founded in 1885. I'm trying to review and recommend more stocks, but as I've mentioned in previous videos, I'm afraid right now, I think everything is overpriced. If you look at almost every valuation, every company is overpriced. The proper recommendation would be wait for a 20% pullback and then invest, but I don't know when or if that'll ever happen. My advice for any investor is try not to time it, just invest weekly or monthly if you can. Before I get into it, if you're a beginner Canadian investor and you're looking for tips, advice, or starting points, I've created a small ebook to give you some guidance. All you have to do is sign up with your email to get access. I've been recommending dividend paying stocks, mainly low beta or defensive stocks, since the market tanked. Low beta means it's less volatile, it has less dramatic movements compared to the overall market. If the S&P 500 goes up by 2%, a low beta or defensive stock might only increase by 1%. But on the flip side, when we're in a recession, that means they don't decrease as much as the overall market, and we'll see that in a minute. Ticker symbol J&J on the New York Stock Exchange, currently trading at $169, which means they're worth almost $500 billion in market cap. They pay a 2.67% annual yield. The dividend is paid quarterly. That is not a quarterly yield, that is annual. We can only judge a company's performance if we compare to their peers and the overall market. Johnson & Johnson is down just over 1% in the first 9 months of 2022. Looking at Pfizer, which is a competitor, they're down 1.5%, so we're in line there. Looking at the S&P 500, which is the largest 500 companies in the US, they're down 11.6% year to date. So that's an example of a low beta or defensive stock. This stock gets recommended by every dividend growth investor, and it's easy to see why. They've been increasing their dividends for over 60 years straight, a feat only 30 or so other companies have ever managed, and the increases are pretty high. So not only will you be receiving dividends every year, you'll be receiving increasing dividends. Looking at how much they've grown their dividends over the last 5 years, the cumulative annual growth rate is 5.87%, and it increases as we move to the 10-year growth, and the 20-year growth rate is 9.36%. So the dividend growth is slowing, but you can't expect a 9 or 10% growth rate. It's just unreasonable. I would be happy with 5%. Every other year except 2022, I'd be saying at least your dividend growth is beating inflation, but not this year. If we look at their most recent earnings in Q2 2022, they beat estimates by 0.1 billion. Instead of 23.9 billion, they earned 24 billion, but they reduced their guidance, meaning they reduced their forecast for the future, mainly due to the strengthening of the US dollar. Since they have global sales, the strong USD means lower foreign sales. The foreign sales earn less because of the currency. Any decrease in the US dollar will increase their earnings, so adjust your own personal expectations for the next earnings cycle if you're day trading or swing trading. Why I'm such a big fan and confident in recommending this company for long-term growth is their cash flow. If you've watched any of my previous stock breakdowns, I care a lot, maybe too much, about cash flow. I want to know how your operating business is doing. Like, without financing, without investing, how does your core business perform? Can it generate cash? Can it generate enough cash flow to cover your dividends and then leave a margin of safety? Johnson & Johnson was able to produce $9.5 billion in cash from operating activities. Their dividends were $5.7 billion, which leaves a good buffer to grow the business, but instead they've spent $2.6 billion in buying back shares. I have mixed feelings about this. It provides short-term growth. If you're a shareholder, your stock will appreciate in the short term. Management wants to buy it back because it artificially inflates the share price. The majority of the C-suite's income is share-based, so they're biased towards increasing the share price over the short term. I know they should also care about the long term, but they're buying back the company's stock, and it's only a short-term boost in stock price. I believe using that cash to reinvest into the business will give the stock a long-term boost, but what do I know? They have 3 revenue streams of the company: consumer health, pharma, and med tech. They're actually planning on spinning off consumer health into an entirely separate public company. We'll get more details towards the end of 2022, but it's already been announced and it's in full swing. The new consumer health company will have 4 brands that earn over $1 billion in sales, including Tylenol and Neutrogena. To be honest, I'm confused. If it's so great, if the company's doing so well, Why split them up? If the company and everything is doing well, why split it in two? The first thought that comes to mind is it to shelter the consumer sales from potential lawsuits from pharma sales? I'm not sure, but I'm just guessing, but I'm probably right. Personally, I would invest in the consumer health and consumer products brand going forward. The pharma sales seem too volatile. If there are more COVID cases and lockdowns, pharma will obviously do well because of the vaccine sales. But if everyone moves on and COVID dies down, I'm guessing those guaranteed vaccine sales will drop, if not disappear altogether. Who knows? Only the future will tell. That's it for this video. I try to keep my review videos short. I know some more people watch to the very end, which helps the algorithm, I guess. Let me know if you have any stock recommendations. Please only recommend like real or established companies. I keep getting recommendations for 6-month-old startups or new companies that just went public. I really can't make a judgment on a new company. I need years of data to evaluate and feel confident recommending. That's all, folks.